students. Today we are to discuss inventories or IAS 2. First of all, we will discuss theory of IAS 2 and then we will solve various questions that appeared in CAI past papers. Now let us start from the theory. Students, IAS 2 inventories states inventory refers to stock of goods which a business holds in a variety of forms. It may be in the form of raw material, it may be in the form of work in progress, it may be in the form of finished goods that were completed by the organization, or finished goods that were bought for the purpose of reselling. So these types of inventories are possible with the business in the normal course of business. Now let us learn what is rule of inventory valuation. Students, rule of inventory valuation is lower of cost and net realizable value. Here you need to remember is lower of cost and net realizable value, not or net realizable value. Students often write it lower of cost or not net realizable value. That is wrong. The correct is lower of cost and net realizable value. Now let us discuss what is cost. Students, cost normally refers to purchase price plus carriage inward or any other handling cost or any other cost bringing the inventory into its present location or present condition. We can say any cost incurred on inventory to convert it into saleable condition will be included in its cost. Normally in a CI's question only two costs are given, purchase price and carriage inward. So if we add carriage inward in purchase price, we will get cost of an inventory. Now let us try to learn net realizable value. Students, net realizable value is selling price minus selling expenses minus cost of completion. Selling price at which inventory can be sold, any expense to sell, any commission on selling, and any repair cost, any repackaging cost will be the all types of costs related to sale of inventory will be subtracted from the selling price to calculate net realizable value, and the rule is lower of these two values. For example, if the cost is 100 and net realizable value is 90, so the value will be 90. And if the cost is, for example, 90 and net realizable value is 100, then the inventory's valuation will be on cost. IAS 2 allows two methods of inventory valuation, first in first out and weighted average cost method, while last in first out is not allowed to calculate cost of inventory. As we already discussed, there might be three types of inventories: raw materials, work in progress, and finished goods. IAS 2 states raw material inventory can be calculated lower of cost, and cost can be calculated using 5 for EPCO, lower of cost and net realizable value. While when we are supposed to calculate the value of work in progress and finished goods, it will not only include raw material, but it will also include direct labor, direct expenses, royalty, production overheads, and it will not include abnormal losses, storage cost, selling expenses, admin or office overheads. So this was the theory of IAS 2. Now let us try to solve questions from various EAI's questions. In this question, students, all goods are sold at a markup of 50%. Inventory included some defective goods returned from customers at their sales value. So inventory included at 7500 at its sale value, while we need to calculate its cost, we need to calculate its net realizable value. So students, because it was sold on 50% markup, so 7500 is the selling price. On selling price we can't apply markup, so we will convert markup into margin. If markup is 50%, it is 50 over 100, and we convert it into margin, it will become 50 over 150. So 50 over 150 will be into 7500 will be equal to 2500. So the cost of that inventory is 7500 minus 2500, that is 5000. 7500 is the sales price, 2500 is the profit that was added, and so the cost is 5000. So students, cost of that inventory is 5000. Now let us try to find out its net realizable value. It can be sold at 6600. So selling price is 6600. After deducting repairs cost, we will get NRV, net realizable value. So 6600 minus 1800 is equal to 4800. This is net realizable value. So students, cost is 5000, net realizable value is 4800, and the lower is 4800. So actually we had to record it at 4800, while it is recorded in the financial statements as 7500. So clearly you can see inventory is overstated. How much? 7500 minus 4800. So inventory is overstated by 2700. So if we are supposed to calculate the value of inventory, we will subtract 2700 from the inventory. If we are supposed to calculate corrected profit, we will subtract over valuation of inventory from the profit. So profit will be decreased by 2700 and inventory will also be decreased by 2700. Now let us move to the next question. In this question, students, same markup is 60%. Defective goods with a sale price of 28,000. Now, first of all, try to calculate its cost. So the sales price is 28,000 and markup is 60%. We can't apply markup on this value. So first of all, we will convert markup into margin. 60% means 60 over 100, and if we convert it into margin, this will become 60 over 160. So if we multiply it by 28,000 by 60 over 160, this will be 10,500. So if the selling price of inventory is 28,000 and profit included in that inventory is 10,500, so the cost of that inventory will be 28,000 minus 10,500, and this will be equal to 17,500. And students, this is cost of that inventory. The cost value of the return goods that had been included in the inventory. So this 17,500 is recorded in the books of accounts. On 31st December 2021, it is expected that 6,000, if 6,000 is incurred, it can be sold at 80% of the normal selling price. So first of all, we need to calculate 80% of the normal selling price. Normal selling price is 28,000. Its 80% will be equal to 22,400. So it can be sold for 22,400 if repair cost of 6,000 is incurred. So net realizable value will be equal to selling price minus repair cost. This will be 16,400. So students, its cost is 17,500. Its net realizable value is 16,400. So lower value is 16,400. We will record inventory at this value, while it has been recorded at the value of 17,500. So inventory is overvalued by how much? 17,500 minus 16,400. This is 1100. This 1100 will increase loss. It will be subtracted from profit. And if we are supposed to prepare a statement of financial position, this 1100 will be subtracted from the total value of the inventory as well. So students, let us move to the next. This was the question from May June 22, question number 2, and the first question that we solved was from May June 25, paper 3-2. Let us move to the third question. Yes, this is third question. In this question, there are three categories of inventories. Purchase price is given, selling price, estimated repair cost, and estimated selling expenses is given. From these three columns, we can calculate its net realizable value. So students, first of all, we should calculate net realizable value. Net realizable value of A is 98,000 minus 7,000. That will be equal to 91,000. And for B, this will be 14,000 minus 3,000 will be equal to 11,000. For C, it will be 12,000 minus 2,500 minus 1,000. It is 8,500. So these are the net realizable values. So, and by applying the rule of inventory valuation, lower of cost and net realizable value. So students, for A, cost is 57 and net realizable value is 91,000. So we will value A at 57,000. So for A, it is 57,000. For B, cost is 13,000 and net realizable value is 11,000. So that means B will be valued at 11,000. So the value of B is 11,000. Cost of C is 10,000. Net realizable value is 8,500. We will value it lower value. So it is 8,500. So valuation of inventory C is 8,500 and the total becomes 76,500. Now students, inventory was recorded at cost. So the cost of all these three inventories was 80,000, while we must record it as 76,500. So that means there is a loss of 80,000 minus 76,500. This is 3,500. So profit will be decreased by 3,500. So we can subtract this value from here, and inventory will also be decreased by 3500. Now students, let us move to the next question. Question number 4. Here is question number 4. Inventory includes one product which had been accounted for at a selling price of 40,000 and the markup is 25%. Markup 25% means 25 over 100, and when it is converted into margin, 25 over 125. So 40,000 into 25 over 125 will be equal to 8,000. So 8,000 is the profit included in the inventory. So the cost of the inventory will be equal to 32,000. This is cost of the inventory. Now students, cost of the inventory is 32,000 while it was recorded in the books of account as 40,000. So the lower value is 32,000. It will be, inventory will be recorded at 32,000, and when we are supposed to prepare a revised statement of financial position, we will record their inventory at 32,000. And if we are supposed to prepare corrected profit statement, 8,000 will be subtracted from profit. This question was from May-June 21, P32. Now let us move to question number 5. Question number 5 is from May-June 18. Variant 3.1. Question number 3. Goods have been included at their original cost of 12,000. So the cost is 12,000. They could only be sold at half of the normal selling price, which was 25% above cost. First of all, we need to calculate the normal selling price. 25% is the profit that is added. 25% of 12,000 is 3,000. So normal selling price is 15,000. Now it could be sold at half price. Half of the 15,000 is 17,500. This is its net realizable value. Net realizable value is 7,500 while the original cost was 12,000. That means the inventory is overvalued by 4,500. So in corrected profit statement, 4,500 will be subtracted and 4,500 will also be subtracted from the value of inventory. Now let us move to the last question of this video. This is from October-November 2015. Inventories have all been valued at 73,100. So this is the total value of the inventory. Included in this valuation are some items which originally cost 5,000. So the cost is 5,000 but have been damaged. This would normally sell for 10,000. The items could be repaired at a cost of 3,000, then sold for 6,500. So if we calculate its net realizable value, these items now can be sold for 6,500 after repairing of 3,000. So the net realizable value will be 3,500. So students, in this case, cost is 5,000, net realizable value is 3,500. So inventory value will be valued at 3,500. That means value of inventory should be decreased by 1,500. So students, correct value of inventory will be 73,100 minus 1,500, and that will be 71,600. So in this case also, if we are supposed to prepare a corrected profit statement, 1,500 will be deducted from the draft profit, and 1,500 is also deducted from the value of total inventory to get the correct value of inventory. Students, we discussed 6 questions from IAS 2 that appeared in CAI past papers. You might have noticed that IAS 2 requires rule of inventory valuation, as well as you must know the concept of markup and margin to be able yourself to solve questions. Thank you, students. Inshallah, next video will be on IAS 8. Allah Hafiz.